In this video, I will review and share with you the secret to trading the M&W patterns successfully and profitably. Therefore, I urge you to pay close attention, memorize the information presented here, and follow the advice I give. This is iThrive FX, and I'm Lawrence. Welcome back to the channel, everyone. The goal of this program is to help you consistently make money in the forex and day trading market. M&W patterns are also known as double tops and correspondingly double bottoms. The M&W patterns appear when price reaches two peaks in a quick succession. These peaks may or may not be at the same price level. Types of M patterns. The M patterns occurs on an uptrend market, which means the market is moving on an uptrend, forming the higher highs and the higher lows, the higher highs and the higher lows. So we can spot the M patterns on an uptrend market, which we call the bullish market. So here are examples of the M and W patterns and also the entries that we could place our positions and our orders around. We have three types of the M patterns, and they have the number one, we've got the simple hem, which is also called the regular hem. We have the extended hem, which is also called the trap hem. We then have the short formed hem, which is also called the outside structured hem. So here is the simple hem and how it looks like. And here is the entry. If you're an aggressive trader, you can look at placing your orders or your entry here at this peak of the second M here, the second leg of the M. Or if you're a conservative trader, you could wait for a break of this neckline here, and then you place your entry, and your stops could be around this zone at this high here. But if you're placing your entry here, your stop loss could be above this double tops, which is this M formation here. So, and then you could ride it up until this zone and even further than this. So guys, what happens? What are the occurrence of the M pattern? The M patterns happens when the price can't keep going up because sellers are putting pressure on it at its highs. During a market rally, sellers take control all of a sudden and drive the price down to this zone. The price starts to go down to a level that buyers find appealing. When buyers enter the market, they push the price up to form a second top, which is what we have here, forming a double tops. At the second top, the price meets new selling pressure, which pushes it down past its neckline. When the price goes down below the neckline that was set between the two peaks, then an M pattern is formed. This is literally just like the letter M in the alphabetical order. So here, this is the M pattern here for the simple hem. And here, this is the extended hem that can also be called the trap M. For the extended M, it literally means that price keeps going up, but then once this new high is formed, if you can notice here, there is a push above this high, which means there are orders here, orders of traders that has been liquidated by the dealers. So here, once they've been able to get and accumulate enough orders at this region, that is when they start to push price back down. if you're an aggressive trader, you could look at placing your entry at this peak, which is where this new high is actually formed, and your stops could be above here. But if you're a conservative trader, you could wait for price to break this neckline, and then you place your entries, your orders here at this neckline. So here, for the short form hem, this is a variation or a pattern. It's literally the same as the simple and the extended hem, but kind of different. See, guys, the patterns would actually happen the same way, you understand? So on the chart, it could look a bit different. So the reason why they don't do this or this is because the dealers have enough liquidity already, which means they have enough traders trapped here. So once they move the price up to the zone and then they drop price back down here, why they are not forming a new high or exceeding this high, it's because number one, they have enough volumes of traders trapped already. So what they don't want to do is they don't want to relieve the traders that are already trapped long into going into break even. It's all about the money for these guys. It's literally all about the money. So once they've moved the price up to this high and then a new high is trying to form, they don't want to release the accumulation of orders that they already have. So instead, they just shift the zone and then they start dropping immediately from here. So yeah, so the M patterns happen when the price, just like I explained already to you here. So let's go into the charts and let me show you some examples of some real chart examples, real life examples of the M patterns. So here, guys, this is pounds, dollars, the GBP USD. As we can see here, we have an M pattern forming here. This is the 1 hour time frame. You can see the M pattern forming here on this zone. The M pattern forming here on this on this trade here. You can see the M pattern forming here. So this is literally what? This is the M pattern forming here. So this is the M pattern forming here. This is the M pattern forming here. Give me a bit of time. This is the M pattern forming here. So this is what? An M pattern that we've got here. So price was forming, continue. This is an uptrend market. This is an uptrend market. The price was pushing up and then an high was formed. And then sellers pushed price back down to this to this zone. So price was pushed back down to this zone, and afterwards there was a buying pressure here from the zone, and then it was pushed back up to form, and then here, as you can see, notice here, there were orders sitting above these zones, and once this new high was formed, those orders were taken out. Those that were looking at going shots from here, their orders was liquidated, and it was taken out. And then that was when we have a shift in market structure. This is an M pattern forming here. And then let's go over the chart. Let's see if we could spot different another hem as well. All right, so guys, here, if you notice, we have a short formed hem forming here. This is an example of a short formed hem forming here. So you can see, here is an example of a short formed hem forming here. So that is the short formed hem forming at this zone here. So if you're an aggressive trader, you can look at placing your entry from here. You could look at going short from here. You could look at going short from here. But if you're conservative traders, you will just wait for a break of the neckline here, and then you could look at placing your orders at this zone. So if you're an aggressive trader, you could look at placing your stop loss here, just 50 pips, and then you could look at targeting a ride of over 200 pips. So that is you're risking 1% of your account to get 4%. So if you're a conservative trader, you can look at entering at this zone here. Once this neckline has been broken, and then you could place your stop here, and then you could look at targeting way below this zone because the market keeps tanking. So yeah, so those are the examples of the M and W patterns. So let's go back into the W patterns. So yeah, the W patterns happens on a downtrend market. So it signifies that the trend is about to change direction. So the three types of the W patterns are the simple W, the short formed W, and the extended W. So the M and W patterns are literally the same variations, just that they are flipped. So the M happens on an uptrend market, while the W happens on a downtrend market. So the W pattern happens when price can't keep going down because buyers are putting pressure on it at its low. During a market rally, buyers take control all of a sudden and drive the price up. The price starts to go up to a level that sellers find appealing. When sellers enter the market, they push the price down to form a second bottom. At the second bottom, the price meets new buying pressure, which pushes it up past its neckline. When the price goes up above the neckline that was set between the two peaks, then a W pattern is formed. So literally, this is the W patterns, and these are the variations and the examples. So let's go into the live chat and spot some real life examples of the W pattern. Let's try, yeah, this is euro dollars. So here we have this neatly ongoing W pattern on the euro dollar. So this W pattern is the regular W pattern that we have here, as you can see. So a zone is literally created here, and then this is the W pattern. This is the W pattern, and then if you notice, so you can look at taking your entries, just like I explained to you guys. You can look at taking your entries here if you are an aggressive trader. If you are an aggressive trader, you could look at taking your entries from here. So which means your stops could be around here. Your stops could be around here. So guys, I'm just trying to pick the picture perfect kinds of setups that are literally happen real life. So we might not find a crystal clear setup as this all the time, you understand? So you could look at taking a trade if you're an aggressive trader from this particular entry, your order from this particular entry, or you could wait once this neckline is broken. Once this neckline is broken, and then once this neckline is fully broken, you could just place your stop below this zone here, and then you could be looking at riding above here. Or better still, you could also wait for this zone to be broken. You could also wait for this zone to be broken, and then you could also then place your orders or your entries here, and then your stops can be further extended below this zone here. So yeah, so guys, so let's look for other examples of a W pattern. So yes, guys, we have a W pattern that also formed here at this zone. There's a W pattern that also formed here at this zone. Not too clear per se, but it's a W pattern, yeah. So this is a W pattern as well. So you could look at placing your entry. Look at placing your entries here, or if you're an aggressive trader, you could look at placing your entry at this zone here. Once this liquidation has been done, You could look at placing your orders, your first, as an aggressive trader, you could look at placing your entries here, or you could wait for a break of this structure here. But no, this is not a crystal clear W because we have an extension here. So let's go to gold. As you can see here, we have a neatly ongoing M pattern here. This is an M pattern here. This is an M pattern forming here. This is an M pattern here forming here. So if you're an aggressive trader, just like I said, you could look at placing your orders for going short here. Look at taking your positions here, and then you could ride this trade for a very good amount of pips. Or if you are a conservative trader, you could look at taking your orders here and then just placing your stops above this zone here, and then you could look at writing this trade further here. And if you notice, we're having, this is just like I explained to you, the M happens at an uptrend market. So it signifies the reversal of an uptrend market. So here, it's now forming a new change of trend direction, which means the trend is now on the bearish ride. And if you guys can notice here, you could see different variations of an M pattern also happen here. A different types of the M pattern also happening here. So you could look at taking your orders, your entries from this zone, or you could wait for a break of the neckline at this zone, and then you could look at riding further downwards. So this is a W pattern that is happening here on gold, 1 hour time frame. This is a W pattern ongoing on gold. So for an aggressive trader, you could look at taking your entries here. You look at taking your entries here, your stops literally be at the low, below this low, and then, but if you're an aggressive trader, you would just literally wait for a break of the neckline. So once this neckline is broken, you could look at taking your entries here. If you're looking at going long, you could look at taking your entries here. You're looking at going long. So guys, so these are the types of the M and the W patterns that we have. So why do we trade the M and the W patterns? The M's and the W's are helpful in determining whether or not there has been a major change in the direction of the trend. You can spot the M and the W chart patterns on all time frames. Spotting the M and W's on the chart are relatively easy. These patterns may also be used in conjunction with other confluences, indicators, and trading system to provide further validity for your setups. The M's and W helps to minimize risks in trading. When trading the M and W patterns, patience and discipline are two of the most important qualities to consider because of the unpredictable nature of the Forex market. The only way to ensure financial success as a trader is through careful risk management, because in the Forex market, we win some and you lose some. Risk management is the only way to be a successful trader. That is what distinguishes a true winner from one who is just gambling in the Forex market. So guys, I want to say thank you to everyone who stuck around until the end of this video. If you're new to the channel, I hope you will consider subscribing. It is crucial that you learn the skill to recognize these M and W patterns, and that you include the M and W pattern as part of the confluence you use in your trading strategy. Please leave a comment below if you have any questions about the M and W patterns. I will do my best to respond to them all. If you aren't already aware, we've established a Telegram group for traders to share ideas, information, and tips, as well as to facilitate networking opportunities.
You can find the link to our online community of successful forex traders in the description below. Our goal is to make it the largest of its kind. Like and share this video with as many people as you can who could benefit from it. And don't forget to subscribe to the channel for more helpful content like this. Have a great day until we meet again.